Good evening, everyone. We are Group 2. Our project is about VIX, implied volatility, and local volatility. VIX was originally designed to measure the market expectation of 30-day volatility implied by the at-the-money SP100 index option prices, which is also called the old VIX. 10 years later, the updated VIX was introduced to the public based on SP500 index. The Shanghai Stock Exchange once launched IVIX on June 26, 2015, to reflect investors' expectations on the volatility of 5-day euro ETF in the next 30 days, but suspended the release from February 20, 2018. The components of the VIX index are near-term and next-term put and call options with more than 23 days and less than 37 days to expiration. The selected options are out-of-money SPX calls and out-of-money SPX puts, centered around an at-the-money strike price K0. As a technical sentiment indicator, VIX helps to determine the market bottom and short-term fluctuations. When the VIX index is too high, it means that the market has irrational panic about the future, and investors may buy put options regardless of cost. And when the VIX index is too low, it means that the market is experiencing irrational prosperity, and investors have become too complacent. It is generally believed that the abnormally high or low of VIX is often a signal that the market is about to reverse. Therefore, VIX is also one of the so-called countering indicators. Here is a formula to calculate time to expiration, which is measured in minutes. In our project, we find that the annual risk-free interest rates ranging from 2% to 6% have little impact to VIX in China market. So we assume R equals to 2.7% for China market, which is a 1-month SHIBOR interest rate. As for the US market, the evaluation date of our data is February 17th, 2021. The near term and next term have more than 23 days and less than 37 days to expiration. So we choose USD LIBOR 1-month average, that is 0.118% as near term and the next term interest rate. Here is the forward index level F. We should identify the strike price at which the absolute difference between the call and put prices is smallest. Then we can calculate the forward index level using this formula. K0 is the strike price immediately below the forward index level. Here comes the mid code. The reason why we choose out-of-money put and call options is that out-of-money options have better liquidity so that the implied volatility is more valuable. Here is the dirt K. Dirt K is half the difference between the strike price on either side except for the smallest and the biggest K. Then we can calculate sigma square since we have already get all the parameters. And then we can calculate VIX using this formula. Here, N is also measured in minutes.
Now it's about the part 3. We will discuss about some VIX calculation results. The VIX calculation results for SPX on February 17th, 2021 is about 21. It can be seen that our result is quite close to the result in Yahoo and Wind. Below this figure shows the VIX calculation results of 15 ETF, 300 ETF, and Index 300. Although the price level of the Index 300 and 300 ETF options are different, the VIX calculation results are basically the same, and the VIX of the 50 ETF options is slightly lower than that of the 300 ETF options and the index 300 options. Let's look about the VIX effectiveness in Chinese market. The 10-day moving average of the VIX plus or minus the 10-day standard deviation of VIX constitutes the blue areas. VIX out of the Bollinger Band obviously happened 4 times. And first, the outbreak of an epidemic in China at the end of the January 2020 caused a panic in the market. And then we know that the US stock market triggered circuit breakers 4 times in March, and the global epidemic broke out. Therefore, the VIX in China rose rapidly in March. Then, on July 14, 2020, the Chinese stock market crashed. The main reason was that the economy recovered in second quarter beyond the expectations, which triggered panic about the tightening of the liquid in the market. But it was only adjustment of the 2020 bull market. Finally, the corresponding events at the end of 2020 are mainly due to first is the upcoming Chinese New Year, and second is the UK's lockdown due to the mutant virus. Third is the rise in the US dollar index and the risk yield of the 10-year treasury bonds. Finally, let's look about the ETF 15 VIX. Observing the 50 ETF options with the longest history, we can see that from a macro perspective that the VIX better captures. First is the stock market crash caused by the stock index futures at the end of the June 2015. Second is the trade war with the United States on February 2018 lead to an increase in the risk aversion. Third is the outbreak of the epidemic in the first quarter of the 2020.
The fourth part is the construction of implied volatility surface. First, we directly apply the implied volatility of SPX out of the money options on February 17th to plot the implied volatility surface. Generally speaking, the implied volatility surface has characteristic of volatility smile and volatility skew. From the figure, we can see that, given the maturity, there is a clear volatility smile in the volatility curve, where at the money option volatility being the lowest point. And the volatility smile is more obvious for short-term contracts, while volatility curve for long-term contracts is quite flat. Besides, we can also observe a reverse volatility skew that implied volatility of put option is higher than call, indicating that investors are bearish on future SP 500 index. In terms of historical data, SPX has indeed been falling from February 17th to March. From the perspective of term structure, implied volatility for short-term contracts is higher than for long-term contracts, which means investors prefer to pay more for short-term options.
In China, we randomly select the contract data of 50 ETF options on 2 observation days based on the BS model and interpolation to construct an implied volatility surface. By comparison, we find that implied volatility surface of 50 ETF options is similar to that of SPX options in our example. Both have significant implied volatility smile. Also, implied volatility skew is obvious, especially in February, which reflects investors' pessimistic expectation about the market. Since the end of Spring Festival in February, China's stock market has been sluggish, and major blue chip stocks represented by multi fell sharply. Therefore, based on blue chip index SSE, 50 ETF also fell accordingly. This explains why the implied volatility of put options in February is so high. Then we compute local volatility in terms of implied volatility through Dupuy's equation. We use the notation here to calculate the partial derivatives and plug this into the Dupuy's formula. After calculation, we get a final result expressed by the implied volatilities. We solve this equation by finite difference methods. And these are the local volatility surface we obtained. We can observe that they are not as smooth as implied volatility surface in the previous slides. This may be the error caused by interpolation using limited quotation points.
The last part is the conclusion. In this article, we use the market data of SPX option contracts on February 17, 2021 to reconstruct VIX according to the method provided by CBOE. The calculation result is fairly close to the public announced VIX, and then we apply the same method to 5-day ETF, 300 ETF, and Index 300 options to obtain the VIX for China market. Analyzing combined with Bollinger Band, we think VIX is an efficient market sentiment indicator because trends and the peak values of VIX can reflect certain market events. As a predictive indicator, whether VIX exceeds the Bollinger Band can indicate whether the market trend will suspend or reverse. After that, we construct the implied volatility surface for SPX options and 5-day ETF options, and find that in our example, the implied volatility surfaces of options in China and the US have similar shapes, both showing obvious volatility smile and volatility skew. For a specific tenor, the implied volatility of out-of-money put options is greater than that of out-the-money call options. The shorter the expiration time, the more significant the volatility smile and skew. From the perspective of term structure, implied volatility of short-term contract is higher than that of long-term contract. Finally, we compute the local volatility. In terms of implied volatility through the Dupuy equation, the local volatility surface is relatively unsmooth and has many outliers. This is due to the error caused by the interpolation of limited quotation points. That's all. Thank you.